This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker. I am here with Manus Clancy, and welcome to this week's episode. Manus, it seems to me this was another week when the market's second half optimism really needed an asterisk. You know, the war in Iran heated up again, stocks turned volatile, borrowers essentially got no relief. The 10-year Treasury touched 4.62 on Monday, and Tuesday's CPI report gave the market, I think, a little oxygen, coming in cooler than expected. That gave the Fed room to hold rates steady at its next meeting, which is in 2 weeks. But inflation's still above target. Oil prices remain hostage to geopolitics. Equity market leadership maybe looks a little bit less bulletproof. IBM slid by 23% on disappointing preliminary second quarter results, and that was IBM's worst day of trading since 1987. And then last, big banks came out with what the Wall Street Journal called smashing earnings reports, and that triggered a flurry of Wall Street activity. So you pick where you want to start, Manus.
I think given everything you've run through, that the CRE market will be tested once again. I thought we were past the window where the CRE market was being tested. I thought the peace progress that had been made in Iran would trigger lower inflation, lower gas prices, higher consumer confidence, and lower long-term interest rates. And what we've seen is really a 180-degree difference from what I predicted and what I was hoping for. To your point, the war in Iran continues. In fact, there was probably more shooting this week than there has been at any time in the last month. Oil prices, while they haven't shot up to that $100 a barrel that we saw in the spring, oil prices are up noticeably since the shooting resumed. Bond yields kind of defy where I think they should be, in the sense that we're now almost as high as we were 4 or 5 months ago. 4.62% on Monday is awfully close to where we were at the peak, I think, which came in May, which is very disappointing. So the CRE market faced challenges in 2025 with tariffs, earlier this year with the war in Iran and the subsequent shocks by oil prices and higher than anticipated CPI and PPI. And now we're going to have to run through the gauntlet once again and see if CRE can continue to soldier on in the face of these headwinds.
Yeah, and I think, my reaction to this CPI headline was to state the obvious. Gas prices did most of the work behind that June drop. And to your point, they're up already in July. I think the percentage I saw was that oil prices are up by 12%. So that good news about CPI, certainly won't stick around. I don't know if you read Fed Chair Warsh's comments, but he testified before the House Financial Services Committee this week and basically used very hawkish language that he has no tolerance for persistently elevated inflation. So the odds of a July rate hike went down from almost 40% to under 15%. And consistent with the comments that he made when he first took this position is he's not commenting on the forecast for rates. He's not tipping his hand on what's next. So I think, if investors haven't already kind of taken out the eraser and forgotten about the hope of lower rates, they're starting to do that and thinking, we better underwrite deals that are based on things like rent growth and what's the quality of tenants and what's the long-term operating performance, because there's no guarantee that rates are going to come down certainly anytime soon.
You've heard this remark many times from many people that if you're investing in real estate and your only strategy is to count on lower rates, then really what you're doing is gambling. And we've had some really good guests on, Richard Hill being one of them. Strip Mall Guy talks about this a lot in his commentary on LinkedIn, that it all begins and ends with getting the right tenants, putting the people in place that can grow rents, keeping your building occupied, operating it properly and efficiently. And if you do that, yes, you could get burned here and there if you have to live through a period of excessively higher rates than you were anticipating. But chances are you're going to muddle through. But if your only strategy is lower rates, there's a good chance that you're not operating your building the way you should be. And there's a better chance that your fingertips are going to get singed. And we saw some of that during the 2022 and 2023 run-up. There it was expectations that zero interest rates would remain forever. And at other times, during other manias, there's this belief that eventually yields will come down 100 basis points and that will solve all problems. And sometimes it does, for sure, but it doesn't serve as a strategy for the long haul. It is really just gambling at that point.
Yeah, exactly. Back to good old-fashioned commercial real estate investing. Did you see Jamie Dimon's quote? Whenever there's a round of big bank earnings reports coming out, you can always count on him for a great quote. And his line of the week was, "It's getting close to as good as it gets." And it just reminded me of that. I think it was a late 90s rom-com with Jack Nicholson, Helen Hunt, Greg Kinnear. If you haven't seen it, sidebar, it's worth it just to see the scene with Jack Nicholson in the hallway with Greg Kinnear's little dog. But I thought it was interesting that here you have Jamie Dimon saying that it's getting close to as good as it gets in the banking world.
It's interesting. Well, first of all, let me start by saying that was a terrific movie. I think it won some awards. I think it won some Oscars. Jack Nicholson was great in that movie. Helen Hunt, Greg Kinnear. It was a terrific watch. I enjoyed that quite a bit. I didn't see Dimon's quotes, but I'd be interested to scratch beneath the surface. If I were to guess, the sweet spot right now is banks are making money on their loans. They're not making 3% loans anymore. They're making 6 and 7% loans, which gives them the opportunity to arbitrage, obviously, the difference between their lending rates and their borrowing costs, their deposit costs, and so forth. And there was a period of time 3 or 4 years ago when they were having negative arbitrage on a lot of their loans. They were making loans in the 3s and 4s and watched deposit costs go up to almost 5% at one point. So on the top line, on the revenue side, I'm sure he's feeling very good. On the stability side, we haven't seen a lot of volatility or illiquidity or risk premium shocks that we've seen at various points over the last 5 years. That has to keep him feeling pretty good. Credit risk, while it was a big concern a few months ago on the PE side, I think people are now thinking we're going to muddle through. We'll see some credit issues, but nothing that's going to be systemic. And I do think that he's probably riding the AI wave to save a lot of money, which will improve his margins. So I don't want to put words in your mouth, Jamie, but did I nail it? Is that right?
I didn't read all of the commentary, but I think you're probably going down the right path. And remember, although the commentary that I saw didn't speak specifically to commercial real estate lending, our listeners might remember we talked about the Mortgage Bankers Association's data for Q1 showing that big banks were back, that originations were up 52% year over year. And I think what's probably behind the comments of Jamie Dimon and the other big bank CEOs this week is, look, like trading is strong, investment banking is very active, and the big banks are in a pretty healthy position. So, by as good as it gets, I don't think that he's saying it's, we're back to the days of easy money, certainly. But clearly banks have the capacity to lend and they're opening the coffers more than they were a year ago, but likely still being very selective.
I do want to go back to the CPI report from this morning and just touch upon that for one more moment, because it was a really, really happy set of prints this morning, and the bond yields reacted positively. The yield on the 10-year dropped about 5 or 6 basis points after the news, but we weren't talking about 0.1% today. What we saw was at the top line in the headline number, analysts were expecting 3.9% CPI. They got 3.6. And on the core, which excludes energy and food, I think they were expecting 2.9 and got 2.6. So this was a very, very benign report. And it just goes to show what could happen if we get back to $70 oil and it sticks, right? At that point, core is very firmly approaching that 2% level that the Fed seeks. And, it's a number where people can lend confidence.
Yeah. And I think the question is how much longer can that last? Because so much of it depends on a peace deal in Iran, which we thought we were close to at the end of June. And come to find out, we're not.
It's been very elusive and very disappointing on both the humane and the economic level. I'm itching for peace in the Middle East for so many reasons, and it's been so elusive.
Yeah, I know. Another thing, I'm not sure if you saw this, Manus, but I wanted to mention before we go into the data dive, and did you know, is also in the news this week, is that the government officially passed the 21st Century Road to Housing Act. It's one of the most significant federal housing measures in decades. I haven't read all the details, but one thing that's written in there is it raises the FHA, multifamily statutory loan limits, for the first time in more than 20 years. So that could be a pretty strong tailwind tailwind for projects along the lines of affordable housing. It could create more opportunities around multifamily, adaptive reuse, infrastructure adjacent projects. So a potentially meaningful federal push for anybody who's involved in housing redevelopment or reuse of other assets into things that could address our affordable housing crisis.
Certainly good news there. And anything that helps us as a nation create more affordable housing is a positive. So a great headline there. I did promise we'd run through the bank headlines very quickly, and we will, just to kind of talk about what a day it's been for banks. Here are some Bloomberg headlines from the last 3 or 4 hours. Goldman beat on earnings with stock trading record revenue, $7.2 billion in stock trading revenue, if I'm reading the headline correctly. B of A, their stock soared today with record stock trading revenue as well. JPMorgan, a record profit of $6 billion, and Wells Fargo coming in above estimates on both investment banking and wealth management. So when you look at that, you're talking about both commercial and investment bank reporting, all reporting better than anticipated, and with a wide variety of reasons. In some cases, it's investment banking, wealth management, trading revenue, et cetera. So when Jamie Dimon says it's as good as it gets, this is pretty good.
Yeah, those are pretty incredible numbers from Wall Street, and so much activity happening this week. So it wasn't just about that dramatic slip in IBM's stock.
Right. That was the worst. The IBM down 23%. You mentioned that before. Worst performing day since Black Monday, which was October 29th, I think, 1987. I remember.
That's pretty impressive, man.
I think it was that. I think it was the 29th. But I do remember, one of the things I do remember from that time is very few people had the stock ticker. There was no CNBC. There weren't television screens on every trading floor, on every bank floor, every bank branch. You really had no idea what was happening, other than maybe you listened to 1010 News in New York and you could hear, they would tell you what stocks were doing that particular day. But they did have this thing called stock phone, which was like sports phone, a 976 number where if you called it up, they would tell you where the Dow was that particular day. And I remember people throughout my office on the phone all day long calling 976, whatever it was, to find out how big the losses were that day. It was an incredible sell-off, 23% in one day. But amazingly, that index was back in the green less than 6 months later.
Wow. It's pretty incredible when you think that you had to rely on a phone for that. And, more recently, I've been going on college tours with my son, and now you go on every college campus and there's kind of a mock trading floor, right, in the college academic building where you can see any stock kind of strolling across. And it's really kind of cool.
I remember my wife used to use the 976 number for wake-up calls. They had a wake-up call service where you could call in, leave your number, and they would call you up if you weren't trusting the hotel operator to wake you up in your hotel for an early morning meeting. So they also had weather and sports. It was a odd time.
Yeah, that's pretty funny.
Moving on, it is that time, Dianne, that time every week where you bring us through the weekly data dive.
We do. So for this one, Manus, I actually went back to the June CRE activity index because we did give listeners an early read on it last week. Commentary that goes with it is about to hit the wire in just a day or so. So if you listened last week, the index came in at a still strong 119.9, but it fell 7% from May's high. So Manus, I think your comment earlier that the market is certainly being tested rings true. So while the June index was still in the healthy triple digits for the 6th month in a row in June, the big question for us is, will it rise or will it fall in July?
I think these headwinds will be enough that if it does tick up, it'll be very modest, and odds are probably more than 50-50 that we see another decline. We do see declines in the summer months from time to time. I do think these headwinds are real. I think that the June number was just a taste of it. So if I'm looking at the glass half full right now, I'm taking some solace from the fact that oil is $75 a barrel, not $100. I'm taking some solace that maybe we see a peace deal coming through. And I'm taking confidence from the fact that we've been through this fire, baptized in a way, the CRE market a few times in the last couple of years. So that gives me some confidence that the number will not fall off the map. If I'm looking glass half empty, I am concerned that a 4.62 10-year Treasury is disappointing, and that at some point, these negative headlines, the oil prices, the ongoing war, that takes a toll.
Yeah, for sure. But I think overall you made our listeners feel a little bit better. So we'll see what happens. I mean, we're actually mid-July already. So we're another couple weeks away from finding out where the index lands.
It does feel like activity in the sales front in the first 2 weeks of July has been decent. I wouldn't call it great, but it doesn't feel like it's stalling considerably. It feels a little bit like April, where lots of deals are getting done, but not the biggest of deals. That we're seeing a lot of the $5 to $50 million deals getting done, a little bit light on the 200 million and up that we've been so accustomed to for the last year or so. But that's all anecdotal. We'll have the real numbers in a couple weeks, and we'll find out where we actually are. But rolling into our next item, Dianne, your weekly Did You Know? What do you have for us?
Well, last week we talked about the World Cup. This week I'm heading to Indianapolis. So I dug out a metric on that market because I'm heading to a meeting there. So the Did You Know is Indianapolis's pre-transactional environmental due diligence is up 20% in the second quarter. And it's the 18th biggest metro in the country for environmental site assessment. So Manus, is Indianapolis what you would describe as a flyover Midwest metro? It seems like it's doing pretty well right now.
Those are big numbers. And we've seen this in the upper Midwest, real outperformance in terms of transaction activity, price firmness, economic velocity. And I think Indianapolis is a good place to do business. I think that you've seen firms move there. They host an awful lot of Super Bowls and NCAA tournaments. And I haven't been there, but I can only imagine they've nailed it right. If you're hosting Super Bowls and NCAA finals, you're probably a pretty fan-friendly and high quality of life location.
Yeah, for sure. All right, I'll report back next week. All right, Manus, let's switch gears and look at the deals that caught your eye this week. You want to start with industrial?
Yes, let's do that. I have a couple of industrial deals that we can walk through. The first one we have is from CRE Connect. This is from Jasmine Kilman. Newmark arranging a $132 million sale of an industrial portfolio in northern New Jersey. This is known as the Featherstone Industrial Portfolio, 13 buildings, totaling almost 750,000 square feet in Woodbridge, Virginia. That's about 23 miles south of Washington, D.C. The second big portfolio sale that hit our radar in the last couple of days, this comes from Shauna De La Rosa. She's a reporter from the Puget Sound Business Journal. A Kent Valley property portfolio sold for $86 million. The buyer there, BKM Capital Partners, acquiring the 5-building portfolio. The portfolio itself totals over 400,000 square feet and is spread between Kent and Tukwila in Washington. Industrial vacancy rates, according to the Puget Sound Business Journal, climbed 10.3% this year. The sale here working out to just over $207 per square foot.
That's interesting. I think we've talked about Puget Sound before. That's definitely a market that's been digesting this oversupply of industrial capacity. So BKM is a company that's specializing in these kind of value-add, multi-tenant industrial and Western Metro. So that deal's pretty much right out of their playbook. The Northern Virginia one you mentioned is interesting because it seems like whenever we talk about the Northern Virginia industrial market, we're usually talking about Data Center Alley. And this is kind of a more traditional infill industrial deal. And it's a pretty solid location. They're near 95, access to one of the biggest population growth metros in the U.S., and obviously a huge government contracting corridor. So that's a great deal, too.
I'll throw you a quick curveball, Dianne. You mentioned data centers just now, and you brought up a story from this week. It didn't make it to our outline, but I thought it was worthy of your insights here, that data centers, they're certainly not something that have a lot of sidewalk appeal, but people are trying to make them look better. Tell me a little bit about that.
Yeah, it was interesting. It was a headline that caught my eye in the Wall Street Journal, and thanks for bringing it up. The headline was, "Can a prettier data center curb the community backlash?" And it kind of made me think of that phrase, putting lipstick on a pig, because, we're reading a lot more about public opposition to data centers, and neighbors are grousing not just about the drawdown on the electricity supply, but the fact that, some of them just resemble prisons. They're these block developments, they're windowless. And so the article in the Wall Street Journal took the position that in an effort to kind of soothe that local opposition, architects are planning data centers that look more like tech campuses. They featured a picture of one that looked like an art museum, really, really pretty. And so I think the next phase of data center development could be shaped as much by neighbors and what they think of it, not just aesthetically, but for the impact on electricity, as well as what planning boards think and the utility constraints as they are by AI demand.
Maybe they could have Banksy create some of those realistic looking rivers in 3D on the side of the building. So it looks like it's a very bucolic venue, right? Really go all out. But I'm a little skeptical here. I have to say, you probably remember this when they first started putting up cell towers, they try to make them look like trees.
Oh my gosh,
And it
yes.
never really worked. There was one for New Yorkers, maybe you know this, especially New Yorkers from Westchester County, which is just north of New York City. When you drive up the Hutch, which is the Hutchinson River Parkway, there was this big cell tower that they put a couple of Christmas tree branches on the side of, and it was fooling no one, right? This was just ridiculous looking. And I think there will be a big difference between good and bad on the data center front. If you're just sticking a couple of artificial Christmas tree limbs on the side of this thing, you're not going to be faking anybody.
Yeah, for sure. That's funny that you brought that up. I can picture it perfectly. They weren't fooling anybody, and you couldn't help but stare at it as you went by. One other thing to mention on the data center front that also made headlines literally within the past 24 hours is that New York just became the first state to block construction of any new large data centers for up to a year so that they can take time to create rules to protect the environment and the energy grid from the facilities that are fueling AI technology. So they are the first to issue a statewide moratorium on these hyperscale data centers. I will say Maine was technically first, but theirs got vetoed. So we'll see what happens with this one.
I think they won't be the last. I think other states will come in and do the same. We know that what happened with shale drilling, New York did not allow that to happen. So all the shale drilling went to Pennsylvania. That may just be the outcome here as well, that people say, okay, you don't want higher land prices in New York. We'll just go across the border in northern Pennsylvania and put them up there. It'll have the same economic impact probably that shale drilling did. It was positive for Pennsylvania, and the environmental impact will be shared between Pennsylvania and New York, with New York getting none of the benefit. So it's, unfortunately the way New York operates frequently. Moving on, we do have a couple of other segments to go through, a couple of sales that I wanted to point out of size. The first one in the office space, this comes from the Real Deal's Hunter Cook. Hines acquired a downtown office building in Austin, Texas for over $700 a square foot. We don't get a lot of comps in Texas. It's a non-disclosure state, so you don't often get a number behind a sale. But here, Hines paying $151 million to Brandywine for 405 Colorado. This is a Class A building, trophy asset that was built only a couple of years ago. So it probably fits that category of high-end, amenity-rich, the kind of thing that people really will pay up for, even in a down office market.
Yeah, and I read that the tenants there include JPMorgan Chase, Bain and Company. So as a buyer, they get income durability in an office market that's pretty cautious. And I think that story shows a lot of the other ones that we've seen playing out in so many other metros across the U.S., that office is selectively hot at the top end of the market for these trophy buildings that are 100% leased and have reliable tenants already in place.
And if Austin is one of these beneficiaries of people moving out of New York because they're afraid of punitive taxes on high earners, Austin could very well be a beneficiary. More people from JPMorgan, more employees from Bain. Might be a very wise acquisition from Hines. Time will tell.
Indeed. And Austin's certainly a metro that's popular where people want to live and work. So that's a good long-term bet on a growing metro.
There we go. Keep Austin weird. Remember that? That was always the T-shirt in Austin.
I thought that was Portland.
Well, we can keep Portland weird too, but I think it's Austin was always keep Austin weird.
Okay.
Moving on to multifamily, our last property type. This last one in the multifamily category from Taylor Driscoll of BizNow. Ponte Gadea has bought the Kensington Apartments for $234 million. The owner there, Kensington Investment Management, selling the 27-story, 381-unit property on Washington Street. This is in the theater district of Boston. So a real high-end sale in the Boston region acquired by Ponte Gadea.
That's great. Boston is another example of a metro that young people want to live and work in. It's just also a very expensive one, not unlike New York.
So, Dianne, do you have a slice of life to close out this week's podcast with?
Well, I will say, Manus, that what's top of mind for me is the latest show that I binge watched on Netflix. I just finished last night a 4-episode series based on Lord of the Flies, which I haven't thought about since I read in high school. And it was fantastic, but it was also very terrifying. It's up for a lot of Emmy Awards, and I do recommend it, but it's very hard to watch and brought back so many memories of Ralph and Piggy being stuck on that island after their plane crashed. So, Manus, what is the last TV show that you binge watched?
Well, I'm not much of a TV watcher, I will have to say. I have a couple. They go so far back that people will laugh. In the 1980s, it was LA Law. So that take me back 40 years. If you're going 25 years ago, it would be 24, Kiefer Sutherland. During COVID, it was Ted Lasso, which I thought was just absolutely terrific. And then most recently, which my wife mocked me for, was something from BritBox, a show called Ludwig, which was like a crime scene type thing. It was, a crime solver, Sherlock Holmes type thing in modern times. And my wife mocked me because she said, there's been so much great TV over the last 25 years, and this is what you settle for. This is terrible TV, and you're watching it.
That's so funny. Ted Lasso was great, and I think the 4th season is coming out imminently in August. So
I hope they don't jump the shark. That was so heartwarming, that show. If you haven't seen it, it's not about sports. It's about life. And it was a terrific, terrific 3 seasons.
Yeah, very true. And the timing for the launch is perfect right after World Cup fever.
Yeah, I can't wait. It was great characters, great character development. I don't know if you remember, I don't want to give away any secrets, but that dart scene, one of the greatest television scenes and heartwarming scenes in recent memory for me.
Oh yeah, that was fantastic. You didn't see where that was going, and it was perfect.
Yes.
All right. Well, thank you to our producers at Bruning Media. Be sure to join us next week as Manus and I drill down into the news headlines, deals, and developments of the week. You can listen on all of your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.